Page number 53. Unit 18. Principles of Lending, Working Capital, Credit Monitoring. JAIIB, Principles and Practices of Banking, Module B. Basic Principles of Lending. The business of lending, which is main business of the bank, carries certain inherent risks, and bank cannot take more than calculated risks whenever it wants to lend. It has to follow a cautious approach based on certain principles, which include A. Principle of safety of funds. Safety of funds means that whatever is lent should come back through repayment of the loan. To ensure safety, the bankers must take into account the willingness, honesty, integrity, character, and financial standing of the borrowers. B. Principle of profitability. While granting loans, it must be borne in mind that whatever loan is given, it should generate income to the bank in the form of profit, which means it should cover the cost of funds, cost of its administration, and risk cost. Hence, the price of the loan products, that is, interest and other charges, should be such that it should amount to profits. C. Principle of liquidity. The money lent should come back as stipulated in the repayment fixed at the time of sanction of the loan. Failing this, the bank may face a crisis of liquidity and mismatch of the assets and liabilities, which in turn would affect the capacity of the bank to meet its own obligations to return the money to the depositors. Delay in recovery could render the accounts non-performing advance. D. Principle of purpose. The loans given for productive purposes help generate additional or incremental income, which works like an incentive to pursue the finance activity. It builds the capacity of the borrower to generate cash and repay the loan. The loans given for unproductive purposes prove burden on cash generation and repayment capacity of the borrowers, and loans in such cases are generally not paid. E. Principle of risk spread. The loans should be spread over a number of economic activities or industries or trades rather than only one or few activities. F. Principle of security. Loans given by the bank should be secured ones so that in case of need, the bank should fall back upon for repayment by enforcing the securities available to it. The unsecured loans can result into loss to the bank, since in the event of willingness or capacity of the bank becoming unavailable, the bank will not be able to recover the loans granted. Due precaution must be taken while selecting securities for the loans. Pre-sanction credit appraisal. For a prudent credit decision with the objective of keeping the sanctioned loan in performing category, it is essential that the banker should know his borrower well. For this purpose, the banker collects or processes information and evaluate the following aspect: purpose of the loan, background of the borrower or his work experience background, operations in the current or any other account, if any, maintained by the party, products are to be manufactured to deal in, positions of availability of various inputs like raw materials to be used, stores to be consumed, labor, power and fuel, and other utilities, computers and competition, estimated turnover and whether achieved taking into account competition, buyers' requirements, place of selling, arrangements for selling, production of the products required for selling, industry outlook, amount of total current assets required to be maintained for achieving the given level of sales, financial standing in terms of own contribution of the partners, directors, proprietor or the organization, level of the liquidity reflected by the current ratio, and net working capital as worked at by doing ratio analysis in respect of old units and projections for the new units, whether facilities asked for in line with the estimated sales and estimated amount of current assets, nature and quantum of facilities asked for, collateral security offered and its value, market report on the party obtained, conditions on which the loan can be sanctioned. Working capital finance. For an uninterrupted functioning of a firm at a given capacity, to achieve a particular turnover level, to remain viable and operate much above the break-even level to earn profits, it requires a specified minimum level of. Page number 54. Current assets, namely raw materials, stock in process, finished goods and receivables, apart from reasonable cash in hand and certain other current assets. Working capital means the total amount of these circulating funds or current assets. In other words, the working capital comprises A. Amount of raw materials of various kinds in store or in transportation. B. Amount of consumable stores and other material required for production purposes. C. Value of stock in process. D. Value of all finished goods including in transit. E. Amount of receivables or sundry debtors. F. Monthly expenses generally reflected through the current assets other than those at A to E, such as cash, advances allowed, prepaid expenses, etc. The means of finance working capital are A. Credit available from suppliers or purchases. B. Other credit liabilities. C. Surplus of long-term funds over the long-term uses, that is net working capital. D. Short-term bank borrowing. Working capital and net working capital. Working capital or gross working capital requirement refers to the funds required for financing the minimum total current assets. Liquid surplus or net working capital refers to the surplus of long-term sources over long-term uses as per RBI prescription. Open bracket. Also calculated by banks as difference between current assets and current liabilities. Close bracket. It is desirable that the net working capital should be positive, which would signify liquidity and availability of adequate working funds. If in a particular case the net working capital is negative, the difference will be called the working capital deficit. Net working capital as per Tandon Committee method is 1.33:1 as per second method of lending. open bracket. 1.17 is to 1, first method, close bracket. Net working capital as per Nayak committee method is 1.25 is to 1. Working capital particulars. Working capital classification: current assets such as cash, stocks, book debts, other current assets. Particulars: net working capital classifications: current assets, current liabilities or long-term sources, long-term uses. Particulars: working capital gap classifications: current assets, current liabilities other than bank borrowing. Particulars: working capital limits classifications: bank facilities needed to purchase current assets. These facilities are cash credit, overdraft, bills purchase or discounting, pre-shipment or post-shipment loans, etc. Factors which determine the working capital. The bankers quite often provide funds to the borrowers without actually understanding the factors which determine the level of working capital needed. In the process, there may either be underfinancing or overfinancing also. The following factors determine the overall working capital levels for the industrial units. A. Policies for production. B. Manufacturing process. C. Credit policy of the unit. D. Pace of turnover. E. Seasonality. Information from borrower. 1. Projected balance sheet. 2. Projected profit and loss account. 3. Projected cash flow or funds flow statement. Concept of operating cycle. Operating cycle represents the time period taken by a firm in 1. Purchasing raw materials, 2. Converting it into finished goods, 3. Selling the finished goods, and 4. Recovery of credit sales to convert in cash. The amount of operating cycle is represented by value of stock of raw material, stock in process, finished goods, receivables and other current assets required to complete one operating period. Procedure for assessment of working capital requirements. Generally, there are 3 methods followed by banks for assessing working capital of a firm. That is, 1. Traditional method suggested under Tandon Committee. 2. Turnover method suggested by Nayak Committee. And 3. Cash budget method followed in case of seasonal industries and also in larger loan accounts in few banks. Turnover method. Nayak Committee. As per this method suggested by Nayak Committee, the working capital is assessed as minimum 25% of the projected sales turnover, which is financed by way of bank finance at minimum of 20% and borrower's contribution at 5% of the projected sales. The norms for inventory and receivables and method of lending are not. Page number 55. Applicable in this method, working capital amount represents minimum 3 months sale. It is used for MSE units up to loan limits of rupees 5 crore, open bracket, rupees 2 crore in trading advances, close bracket. Working capital calculations. For instance, if an MSE units estimates a sales turnover of rupees 80 lakh and that bank, based on the past performance, installed capacity, available market and other factors, satisfies itself about achievement of the estimated turnover of rupees 80 lakh, the working capital assessment would be done as under: estimated sale turnover, open bracket, projected sale, close bracket. rupees 80 lakh. Minimum working capital at 25% of estimated sales, open bracket, which represents 3 months sales, close bracket. Rupees 20 lakh. Contribution of borrower at 5%, rupees 4 lakh. Minimum bank credit for working capital at 20% of projected sales, rupees 16 lakh. Traditional method or MPBF method, Tandon Committee. As per the traditional method, the level of working capital is determined both by the length of the operating cycle and the size of the sales as prescribed by Tandon Committee. The sum total of anticipated current assets and also reasonable level of other current assets would be the level of working capital required. Thereafter, the amount of bank credit can be determined as under A. Assess the level of net working capital, open bracket, surplus of long-term sources over long-term uses, close bracket, available, which normally should not be less than 25% of the total current assets. B. Work out bank finance to be sanctioned being gap of total current assets less NWC and other current liabilities. Calculation of working capital, Tandon Committee, open bracket, method of lending as per RBI guidelines applies to borrowers availing working capital fund based limits of rupees 500 lakh or more only. For other borrowers, method suggested by Nayak Committee applies, close bracket, or where Nayak Committee method is not applicable. Methods of lending, total current assets, first method 1000, second method 1000. Methods of lending, less other current liabilities, first method 100, second method 100. Methods of lending, working capital gap, first method 900, second method 900. Methods of lending, minimum stipulated NWC, first method 225, open bracket, 25% of working capital, close bracket. Second method 250, open bracket, 25% of current assets, close bracket. Methods of lending, permissible bank finance, first method 675, second method 650. Cash budget method. Cash budget is a statement of periodical cash receipts and cash payments. It is different from cash flow statement. Banks make use of cash budget method in case of seasonal industries, open bracket, tea, sugar mills, close bracket. Software development, services sector activities, film productions, opening of LC and Hawk, working capital limits, bill financing, etc. Under this method, weekly or monthly or quarterly cash inflow or outflow statement is prepared and the gap between the two becomes basis for sanction of credit limit. The following steps are required for this method. 1. Actual receipts and payments during the first week, month or quarter. 2. Calculation of position of surplus or deficit at the end of first week, month or quarter. 3. Adding the receipts and deducting the payments of second week, month or quarter and work out the surplus or deficit. 4. Preparation of this budget for entire period of 1 year. The maximum deficit is the basis for calculation of bank limit. Actual drawings are allowed on the basis of availability of security in the form of current asset less the margin to be provided by the party. Non-refund based credit facilities guarantees the borrower in the course of their business to run business transactions smoothly have to make efforts like participation in tenders for expanding market, give security deposits for participation in such tenders, give guarantees for their capacity to perform contracts, avail concession in duty on imports when tagged to some export obligations, etc. These business requirements for goods and services can be met by them with the help of a non-fund based facility known as the guarantees given or issued by the banks. Activities for guarantee facility. The guarantees are generally issued to A. railways and airlines for payment of freight, B. shipping companies for delivery of goods without productions of bills of lading, open bracket. It should be given only in those cases where the relative shipping documents negotiated under LCs opened by the bank have not been received and the relative bill have been retired, close bracket. C. A collector of excise or customs for payment of excise or custom duty. Page number 56. D. Export performance guarantee. E. Purchase of raw materials and other merchandise for business purposes. F. Deposit of earnest money for participating in a contract or tender. G. Deposit of security in performance of some contract. H. Security against dispute with government or with government department or any other party. I. Security against retention money. J. Security against payment of insurance premium. K. Any other purpose or activity deemed appropriate. Appraisal of guarantee requirement. The total credit requirement of a borrower should be assessed carefully rather than looking into the guarantee proposal in isolation. The proposal for insurance of a guarantee should be looked in terms of the contract between the parties concerned, that is, the applicant of the beneficiary, because the guarantee bond to be signed by the bank is subordinate to the original contract, which is of paramount importance. While issuing financial guarantee, bank should be satisfied that the customer would be in a position to reimburse the bank in case of the guarantee is invoked. In the case of performance guarantees, due caution should be exercised to ensure that the customer has necessary experience, capacity and means to perform the obligations under the contract and is not likely to commit any default. Security. Banks should obtain the counter indemnity from the borrower before the letter of guarantee is issued. This counter indemnity gives the bank absolute right of payment on the happening of contingency guaranteed. However, in case where the total guarantee limit has been set up on behalf of a customer, a general counter indemnity should be obtained. In such cases, a specific letter of request should be taken each time whenever letter of guarantee is to be issued within the overall sanction limit. Collateral security, wherever found necessary, can also be obtained. Fixation of quantum or non-fund based limits. Letter of guarantee. The quantum of letter of guarantee can be fixed taking into account the contract between the applicant, that is borrower, and the beneficiary. The contract would specify the amount of guarantee needed to be issued depending upon the type of obligation, which would differ from case to case. For instance, in respect of performance guarantee, the amount of security deposit on some other clause would spell the extent of guarantee required, and in respect of earnest money guarantee, the amount of earnest money to be deposited would become the amount the guarantee required. In this manner, a limit can be set up for a specific purpose, or guarantee or a general limit can be set up for all the guarantees to be issued in a given period of, say, 1 year after taking all the proposed transactions which the borrower wants to cover under the guarantee facility. Letter of credit. In respect of letter of credit, the quantum can be worked out as well. DPLC. Suppose the total requirement of raw materials purchased during 1 year is equal to rupees 24.00 crore, and out of this the raw material which can be purchased through letter of credit is item A is equal to rupees 12.00 crore, item B is equal to rupees 2.00 crore. Per month consumption of item A is equal to rupees 1.00 crore. Per month consumption of rupees B is equal to rupees 0.17 crore. Suppose there is lead time of 2 months for item A, and 2, the lead month for item B is 6 months due to import, and a minimum quantity of import for item B in value is rupees 0.50 crore. The amount of LC limit for item A would be monthly consumption into open bracket lead time plus some cushion time close bracket, that is rupees 1 crore into open bracket 2 months plus 1 week close bracket, that is rupees 2.25 crore. The amount of LC limit for item B would be rupees 0.17 into open bracket 6 months plus 1 month close bracket is equal to 0.17 into 7 is equal to 1.19 crore. If the amount of minimum quantity in this case would have been more than the limit, so worked out, the limit would be based on the minimum quantities value instead of the lead time. DALC. In case the facility of credit is to be given on DA basis, the period of DA should also be added. However, the common lead and DA period has to be given proper treatment without taking that period twice. Suppose the DA period is 2 months in respect of item A and common period is 15 days. The amount of limit would be rupees 1 crore into open bracket 2 months plus 1 week plus 2 months minus 15 days close bracket is equal to rupees 1 crore into 3.75 is equal to rupees 3.75 crores. Page number 57. Credit management. Credit management means following a policy relating to 1. Exposure norms, 2. Capital adequacy norms, 3. Income recognition, asset classification and provisioning norms, 4. Appraisal norms, 5. Loan review norms, etc. As per exposure norms, bank exposure to a single borrower should not exceed 15% open bracket 20% for infrastructure borrowers, close bracket, and to a borrowing group 40%, open bracket, 50% for infrastructure, close bracket, of capital fund of the bank. Short questions and answers for quick revision. Question: list out the basic principles of lending. Answer: the basic principles are safety, liquidity, profitability, purpose, risk, and security. Next question: for which kind of purpose, when the loan is given, the possibility of recovery is better? Answer: for productive purpose, where the borrower is able to generate additional income from the activity. Next question: for what kind of purpose, the possibility of recoverability of the given loan is not better? Answer: speculative, open bracket, purchase of shares for trading purpose, close bracket, and non-productive purpose, open bracket, consumer durables, close bracket. Next question: diversification of risk in credit terms means what? Answer: banks should grant advances to various business segments and activity rather than only very limited activities. Next question: explain the term liquidity in terms of basic principles of lending. Answer: repayment period of advance should be made that the bank is able to get repayment of the loans. Next question: what is meant by credit risk in the context of bank lending? Answer: the risk arising out of borrower's failure to meet his repayment obligation. Next question: how the assessment of limit for bank guarantee is done by the bank? Answer: it is based on the individual transaction where the guarantee is required to be given by the bank. But if there are more than one transactions, an overall limit can be fixed by aggregating these transactions, taking into account the time period for which the guarantee would be given. Next question: how the limit for letter of credit is fixed? Answer: it can be fixed on the basis of value of the material to be purchased through letter of credit, taking into account the lead time, that is, time for placement of order and receipt of the material. Next question: if a firm has got a contract of rupees 2 crore for construction of building and performance guarantee of the value of 10% is required, what will be the amount of guarantee? Answer: rupees 20 lakh, open bracket, being 10% of the value of the contract, close bracket. Next question: if a firm has to purchase raw materials of rupees 3 crore in 1 year on LC basis with average lead period of 2 months, what would be limit for letter of credit? Answer: rupees 50 lakh, open bracket, rupees 3 crore will have 6 cycles of 2 months lead period in 1 year, close bracket. Next question: if in the above case supplier of material is also ready to provide 2 months credit, what will be amount of limit? Answer: rupees 100 lakh, open bracket, rupees 3 crore will have 3 cycles of 4 months, 2 months lead period and 2 months credit period, close bracket. Next question: if letter of credit is to be issued for purchase of capital goods, how the letter of credit limit would be fixed? Answer: it will be equal to the value of the capital goods to be purchased. Next question: if the machinery worth rupees 10 lakh is to be purchased on the basis of deferred payment guarantee of 5 years and the borrower is to provide 10% margin as down payment, what will be the amount of DPG limit? Answer: it will be equal to value of the machinery less 10% down payment plus interest on reducing balance basis for 5 years. Next question: what is meant by working capital or gross working capital? Answer: it stands for the asset which a business organization maintains for day-to-day functioning. These are called current assets. Next question: what is meant by net working capital? Answer: it is a surplus of long-term funds minus long-term uses. Next question: what is the alternative method for working out net working capital? Answer: current asset minus current liabilities. Next question: what purpose is served by net working capital? Answer: it is the margin or liquid surplus available with the borrower. Page number 58. Next question: how much margin or net working capital is expected from the borrower under Tandon Committee and Nayak Committee? Answer: as per Tandon Committee, second method, it should be 25% of the total current assets. As per Nayak Committee, it should be 5% of annual projected sales. Next question: how working capital is computed as per traditional method suggested by Tandon Committee? Answer: based on the estimated sales and the norms for inventory open bracket stocks close bracket and receivables, the value of working capital can be calculated. Next question: how the value of raw material is calculated? Answer: total raw material to be consumed in a year, dividing it by 12 to find monthly requirement, multiplying it with the raw material norm. Next question: if a firm is to consume raw material worth rupees 3 crore in 1 year and looking into lead time it keeps 2 months stock, what should be the value of raw material stock to be kept by the firm? Answer: rupees 50 lakh open bracket 300 by 12 is equal to 25 lakh into 2 months is equal to 50 lakh close bracket. Next question: how the value of stock in process is calculated? Answer: total raw material to be consumed in a year plus manufacturing expenses open bracket cost of production close bracket, dividing it by 12 to find monthly value, multiplying it with the stock in process norm. While doing so, value of opening raw material to be added and closing raw material to be reduced. Next question: if a firm is to consume raw material worth rupees 3 crore in 1 year and manufacturing expenses are equal to rupees 60 lakh, the process period is 15 days, what should be the value of stock in process to be kept by the firm if value of opening or closing SIP is same? Answer: rupees 15 lakh open brackets 300 plus 60 is equal to 360 by 12 is equal to 30 lakh into half months is equal to 15 lakh close bracket. Next question: how the value of finished goods is calculated? Answer: cost of production plus other expenses plus opening finished goods minus closing finished goods, dividing it by 12 to find monthly value, multiplying it with the finished goods norm. Next question: If a firm is to consume raw material worth rupees 3 crore in 1 year and manufacturing expenses are equal to rupees 60 lakh and other expenses are rupees 60 lakh, the process period is 1 month, what should be the value of stock in process to be kept by the firm if value of opening or closing finished goods is same? Answer: rupees 35 lakh, open bracket 420 by 12 is equal to 35 lakh into 1 month is equal to 35 lakh, close bracket. Next question: how the value of receivables calculated? Answer: cost of sales by 12, multiply it with the period of market credit allowed to buyers. Next question: a firm has cost of sales of rupees 480 lakh and the average credit period allowed to buyers is 3 months. What is the value of receivables for working capital calculation purpose? Answer: rupees 120 lakh, open bracket 480 divided by 12 is equal to 40 into 3 months is equal to rupees 120 lakh, close bracket. Next question: in the above manner, what is the amount of working capital excluding other current assets? Answer: raw material plus stock in process plus finished goods plus receivables, that is 50 plus 15 plus 35 plus 120 is equal to 220 lakh. Next question: if other current assets like cash, advances, etc. are rupees 20 lakh, what is the margin, open bracket NWC, close bracket, requirement for the entire amount of working capital? Answer: total current assets is equal to 220 plus 20 is equal to 240 lakh. 25% margin or NWC requirement minus 60 lakh. Next question: in this case, what will be the amount of working capital limits to be sanctioned by the bank? Answer: rupees 180 lakh, open bracket 240 minus 60, close bracket. Next question: how working capital is calculated as per Nayak committee method? Answer: it is minimum 25% of the projected sales. Page number 59. Next question: how margin and bank limit calculated as per Nayak committee method? Answer: margin is 5% of the sales and bank limit is minimum 20% of the projected sales. Next question: if the requirement of a party is more than 25% of the projected sales as per Nayak committee, how working capital would be calculated? Answer: it will be calculated as per traditional method of Tandon committee. Next question: what are the other methods for calculation of working capital? Answer: cash budget method. Next question: in what kind of activities the cash budget method is used? Answer: mainly for seasonal industry, service industry, film financing, software development, etc. Next question: what is meant by underfinancing of working capital? Answer: it means providing working capital limits less than the requirement of the firm. Next question: what is over financing of working capital? Answer: it means providing working capital limit higher than the actual requirement. Next question. Why underfinancing is considered risk prone? Answer. Firm will not be able to achieve the sales level estimated, that will lead to less profit or even loss than projected. Next question. Why overfinancing is considered risk prone? Answer. Firm will not be able to use the funds optimally or will divert the funds for other uses including non-productive. It will increase their cost and would lead to lower profits. Next question. What is the purpose of sanction of term loan? Answer. To purchase or acquire fixed assets such as land, building, plant, machinery, other fixed assets. Next question. Balance in the working capital limits is repaid out of? Answer. Sale proceeds of current assets. Next question. Term loan is repaid by a firm? Answer. Out of profits or cash generation. Next question. What is the difference between term loan and working capital from viability angle? Answer. In term loan, long-term viability is examined. In working capital, short-term viability is looked into. Next question. What ratios are used while appraising term loan and working capital? Answer. For term loan, debt service coverage ratio is important. For working capital, liquidity ratio, that is current ratio, is important besides net working capital. Next question. What is another name of Tandon Committee method? Answer. It is called operating cycle method also. Next question. What is meant by operating cycle? Answer. The period involved in completion of process of production, beginning with placement of order for purchase of raw material till receipt of payment on sale of finished goods. Next question. While providing finance for receivable, the age of receivable should normally not exceed? Answer. 180 days. Next question. What treatment is given to sundry creditors to work out bank limit for working capital? Answer. The value of sundry creditors is reduced from the amount of gross working capital and then margin is deducted to work out the amount of bank limit. Next question. What is the ideal current ratio for providing proper margin for working capital limit? Answer. It is 1.33:1 as per second method of lending of Tandon Committee. In case of Nayak Committee, it is 1.25:1. Next question. As per Nayak Committee's 25% working capital norm, the period of operating cycle is assumed at? Answer. 3 months, open bracket, being 25% of 1 year's period, close bracket. Next question. In addition to seasonal industry, cash budget can be used in which cases? Answer. Units having working capital of large size, say rupees 10 crore. Next question. What is a cash budget? Answer. It is a statement of cash receipts and cash payments. Next question. What is the periodicity for preparation of cash budget? Answer. It is prepared according to requirement of the firm, which may be weekly, fortnightly, monthly, etc. Base rate guidelines. On recommendations of a working group on open bracket Chairman Shri Deepak Mohanty close bracket to review the BPLR system, RBI decided that banks should switch over to base rate system WEF 1.7 2010. These were reviewed by RBI during January 2015 as per recommendations of Anand Sinha Working Group. The base rate system aims at enhancing transparency in lending rates of banks and enables better assessment of transmission of monetary policy. Page number 60. RBI issued the following guidelines to banks. 1. Base rate includes all those elements of the lending rates that are common across all categories of borrowers. Banks may choose any benchmark to arrive at the base rate for a specific tenor that may be disclosed transparently. Banks are free to use any methodology to fix the base rate, provided it is consistent and is made available for supervisory review or scrutiny when required. 2. Bank may determine their actual lending rates on loans and advances with reference to the base rate and by including such other customer specific charges as considered appropriate. 3. All categories of loans should be priced only with reference to the base rate and no loan can be sanctioned below base rate. Exempted accounts. The following categories of loans could be priced without the reference to the base rate. A. DRI advances. B. Loans to banks' own employees. C. Loans to banks' depositors against their own deposits. Open bracket RBI advised on February 21, 2011 that for loans under the scheme of financing of off-grid and decentralized solar open bracket photovoltaic and thermal close bracket applications as part of the Jawaharlal Nehru National Solar Mission JNNSM at interest rates not exceeding 5% per annum would not be considered to be a violation of base rate guidelines. Close bracket. 4. The base rate could also serve as the reference benchmark rate for floating rate loan products apart from external market benchmark rates. The floating interest rates based on external benchmarks should be equal to or above the base rate at the time of sanction or renewal. 5. Changes in the base rate shall be applicable to all existing loans linked to the base rate. 6. Banks are to review the base rate at least once in a quarter with the approval of the board or the asset liability management committees as per the bank's practice. Banks are required to exhibit the information on their base rate at all branches and also on their websites. Changes in the base rate should also be conveyed to the general public. Banks are to provide information on the actual minimum and maximum lending rates to RBI on the quarterly basis as hitherto. 7. Banks can review the base rate methodology after 3 years. 8. Banks can calculate cost of funds on the basis of average costs or marginal cost. Central Registry of Securitization, Assets, Reconstruction and Security Interests of India. Government of India established the Central Registry of Securitization, Asset, Reconstruction and Security Interests of India CERSAI, a government company under Section 25 of Companies Act 1956 on March 31st, 2011. It operates or maintains central registry functions as per SARFAESI Act 2002 under the superintendence and direction of Central Registrar. The majority shareholding 51% is with central government, public sector banks and national housing banks. Types of transactions. It registers transactions relating to security interests over property, transactions of securitization and asset reconstruction. With registration of these transactions, a public database is created about encumbrances created on properties to secure loans and advances given by banks or FIs, as also transactions of securitization or asset reconstruction undertaken under provisions of the SARFAESI Act. The following transactions are not covered. 1. Securitization or asset reconstruction done outside the provisions of the SARFAESI Act, or 2. Security interest created in favor of any lender not included in the definition of the bank or FI as per SARFAESI Act. Who is covered? The institutions notified under the SARFAESI Act have to mandatorily register with CERSAI the eligible transactions. Those not notified under SARFAESI Act can also file their records. The filing of details of transactions for registration is mandatory and is in the nature of a statutory requirement. The following categories of secured creditors are to file the details. 1. Banks. 2. Financial institutions. 3. Debenture trustees appointed by any bank or FIs. 4. Securitization company or reconstruction company. 5. Any other trustee holding securities on behalf of a bank of FI. Failure to complete the filing in time results in a default on the part of the bank, which may result in penalties and reputation risk. Time limit and mandatory requirement. The details are to be filed within 30 days of creation of the mortgage. The right to enforce security under Section 13 of SARFAESI Act is not linked to the registration with the Central Registry, and such enforcement can be done even if there is no registration with the Central Registry. The process of registration. The process of registration of transactions of creation of security interest Securitization and asset reconstruction is carried out through the www.cersai.org.in of the Central Registry. Search of records. The records maintained by the Central Registry are available for search by any lender or any other person by paying fee of ₹50. The registration under this Act is additional or supplemental and does not change or affect the requirement of registration of transaction under Companies Act or Indian Registration Act. Forms and fees. These have been prescribed by the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interests. Open bracket, Central Registry, close bracket. Rules 2011 notified on 31st March 2011. Corporate Debt Restructuring System. Page number 61. Corporate Debt Restructuring System was implemented in India in August 2001. Subsequently, the guidelines were revised in December 2005 as Gopinath Committee. The main features of the mechanisms are given below. Objective. The objective is to ensure timely and transparent mechanism for reconstructing the corporate debts of viable entities. Open bracket, industrial or others, close bracket, facing problems outside the purview of BIFR, DRT and other legal proceedings for the benefit of all concerned. Structure. CDR system has a tier structure, that is CDR Standing Forum and its core group, CDR Empowered Group and CDR Cell. Period and parameters for approval. The group approves the reconstructing package within a specific time frame of 90 days. Open bracket, or at best within 180 days of reference to the group, close bracket. Package. Lead institution or major stakeholder shall work out a preliminary reconstructing plan and submit to the CDR cell within 1 month. The cell will prepare the reconstructing place for consideration of the empowered group within 30 days of decision. Eligibility conditions. 1. It should be multiple banking or syndication or consortium accounts, not a single lender account. 2. It should be corporate borrowers. 3. Total fund base and non-fund base exposure of ₹10 crore and above. There is no requirement of the account or company being sick, NPA or being in default for a specified period before reference to CDR system. Fraud accounts and loss accounts. Ineligible for reconstructing under CDR mechanism. Suit filed account. It may be eligible with consent of the court provided the initiative to resolve the case under the CDR system is taken by at least 75% of the creditors, open bracket, by value, close bracket, and 60% of creditors, open bracket, by number, close bracket. BIFR cases. Large value BIFR cases only may be eligible if specifically recommended by the CDR core group. Category 1. CDR system. It covers standard and substandard accounts, open bracket, minimum 90% of creditors, open bracket, by value, close bracket, certificate treated the account as standard or substandard, close bracket. Reference to CDR 1 system. Reference could be made by one or more creditor who have minimum 20% share is either working capital or term finance, or 2 by the concerned corporate if supported by a bank or a financial institution having minimum 20% stake. Larger accounts, banks or FIs should review all eligible cases where the exposure of the financial system is more than rupees 100 crore and decide about referring the case to CDR system or to proceed under the SARFAESI Act 2002 or to file a suit in DRT, etc. Legal basis. The debtor-creditor agreement DCA and the inter-creditor agreement ICA shall provide the legal basis to the CDR mechanism. ICA is initially valid for the period of 3 years and subject to renewal for further periods of 3 years thereafter. ICA is legally binding agreement amongst the creditors wherein they agree that if 75% of creditors by value and 60% of the creditors by number agree to a reconstructuring package of an existing debt, that is debt outstanding, the same would be binding on the remaining creditors. Standstill clause. One of the most important elements of debtor-creditor agreement would be the standstill agreement, binding for 90 days or 180 days by both sides. Both the parties commit themselves not to take resources to any other legal action during the standstill period. Category 2 CDR system. This consists of cases where the accounts have been classified as doubtful in the books of creditors. Reference can be made if a minimum of 75% of creditors open bracket by value close bracket and 60% creditor open bracket by number close bracket satisfy themselves of the viability of the account and consent for such reconstructuring. Under this category, the existing loans will only be reconstructed and it would be up to the promoter to firm up additional financing agreement with new or existing creditors individually. Central Repository of Information on Large Credit CRILC. Under Section 27(2) BR Act, RBI decided to use the information in Form A open bracket return on large borrowers of 10 crore and above close bracket for Central Repository WEF 1/4/14. RBI created CRILC, Central Repository of Information on Large Credit. Banks are required to send on quarterly basis within 21 days the information relating to 1. Fund and non-fund based loan account of rupees 5 crore and above with PAN details. Loans extended by overseas branches are also to be reported. Exempted loans, crop loans and interbank exposures including to NHB, EXIM, SIDBI, NABRD. 2. Current account balance, debit or credit of rupees 1 crore and above. 3. SMA accounts with exposure of rupees 5 crore and above and all SMA to open bracket banks can report on weekly basis as on every Friday, close bracket.